Between 2014 and 2018, Jeff Bezos's wealth grew by an astonishing $99 billion. His Amazon stock skyrocketed from $30 billion to $129 billion in that short span. To many, it might seem like a staggering fortune, but consider this. In those same 4 years, Bezos paid only $973 million in federal income taxes. That's right, less than 1% of the growth in his wealth. Compare that to someone earning a $60,000 annual salary, who would typically pay around 10 to 12% in federal income taxes. In other words, on your modest income, you're paying 10 times the rate Jeff Bezos pays on his wealth growth, while he accumulates billions. And here's where it gets even more mind-boggling. In 2007 and again in 2011, Jeff Bezos paid zero federal income taxes. Despite being worth over $18 billion in 2011, he contributed nothing to the federal government in income taxes. Elon Musk followed a similar path. In 2018, with a net worth of $23 billion, he too paid zero federal income taxes. Michael Bloomberg, between 2014 and 2018, paid an effective tax rate of just 1.3%, while other billionaires like Carly Khan in 2016 and 2017, or George Soros between 2016 and 2018, also legally paid nothing. This is not illegal tax evasion. This is not some loophole that slipped through by accident. This is a deliberate, legal, and highly effective tax strategy, protected by the American Tax Code and used consistently by the wealthiest individuals to preserve and grow their fortunes without paying billions in taxes. It's called buy, borrow, die. The consequences of this system are staggering. It explains why billionaires often pay lower effective tax rates than their own secretaries, why wealth inequality continues to accelerate, and why the federal government runs trillion-dollar deficits, all while the richest Americans contribute almost nothing in taxes. To understand this strategy, we need to break it down into its 3 simple steps. Understand how it's legal, who fought to protect it, and why you can't access it no matter how much you pay in taxes. The first step is simple. Acquire assets that appreciate over time. Stocks, real estate, private companies, art, and other investments that increase in value form the foundation of this strategy. For example, Jeff Bezos owns 990 million shares of Amazon, and Elon Musk owns 401 million shares of Tesla. As these shares grow in value, so do their net worths. But here's the key. Unrealized gains are not taxed. Unrealized gains are the increases in value of an asset that you haven't sold yet. If you buy Amazon stock at $100 and it climbs to $200, you've technically made a $100 profit, but the IRS doesn't tax it until you sell. For everyday investors, this principle applies too. If your brokerage account grows, you don't owe taxes until you sell your stocks. But here's the crucial difference. Most people eventually sell, whether it's to buy a home, pay for retirement, or cover daily expenses. When they sell, capital gains taxes apply, typically 15 to 20% on profits. Billionaires, however, almost never sell their assets. They simply hold them, letting their wealth grow exponentially, untaxed. So how do they afford to live, buy homes, yachts, private jets, or fund other ventures without selling their stock? That's where borrowing comes into play. Instead of selling assets and incurring capital gains taxes, billionaires borrow against their holdings. Let's break this down. Bezos owns $100 billion in Amazon stock. He goes to a bank like Goldman Sachs or Morgan Stanley and asks for a $500 million loan, using his stock as collateral. The bank approves, charging a mere 2% interest. Bezos now has cash to spend on luxury items, other investments, or personal ventures, all without paying income taxes, because a loan is not considered income. Contrast this with earning a $500 million salary, which would result in a federal income tax bill of roughly $185 million at the top marginal rate. By borrowing instead of selling, the billionaire retains access to capital while avoiding taxation. Even better, the interest paid on these loans is negligible compared to the appreciation of the underlying assets. If Amazon stock grows at 15% per year and the loan costs 2% interest, Bezos effectively nets a 13% gain while borrowing tax-free. This is securities-backed lending, offered by every major bank for ultra-high net worth clients. You need at least $10 to $50 million in assets to qualify. Below that threshold, banks simply don't care. Bezos can borrow $500 million, live off it, then borrow another $500 million when needed. The bank is secured by his stock, which is continuously appreciating. The IRS collects nothing. The billionaire keeps growing richer, and the system works exactly as intended. Here's the final, most powerful step. When the billionaire dies, the step-up in basis rule comes into play. This is how it works. Bezos purchased Amazon shares in 1997 for pennies per share. Today, those shares are worth $180 each. If he sold them, he'd owe taxes on the $179 profit per share. But because he holds them until death, the gains remain unrealized. Upon death, the heirs inherit the stock, and the IRS automatically steps up the cost basis to the current market value. In other words, Bezos's heirs inherit the stock at $180 per share. If they sell immediately, zero capital gains taxes are owed. The $179 gain Bezos accumulated over decades is erased, completely untaxed. Loans taken by the billionaire do not disappear. They're either repaid with a small portion of the estate or refinanced, allowing the cycle to continue for future generations. Bezos lived like a billionaire, paid almost no taxes, and passed the wealth to his heirs tax-free. This is why the ultra-rich can preserve and grow dynastic wealth indefinitely. The step-up in basis wasn't a loophole. It was deliberately written into the tax code. It was created in 1921, just 8 years after the federal income tax was introduced, ostensibly to avoid taxing the same income twice. But in reality, it was a mechanism lobbied for by the wealthiest families of the Gilded Age, Rockefellers, Carnegies, and Mellons, to pass wealth to heirs without government intervention. Congress has repeatedly tried to modify or repeal it, but lobbying is immense. From 1976 to 1980, step-up in basis was temporarily repealed, only to be reinstated after intense lobbying from wealthy families, banks, and real estate interests. Today, organizations like the American Bankers Association, Investment Company Institute, and National Federation of Independent Business spend hundreds of millions annually to preserve this system. Why? Because it benefits them financially. Banks earn billions in interest from loans secured by ultra-wealthy clients. Investment firms maintain capital in the market. Real estate investors borrow against properties and pass wealth to heirs tax-free. The system is protected by lobbying, political contributions, and legal structures like trusts and foundations. According to a 2021 University of California, Berkeley study, the 400 wealthiest Americans own $4.5 trillion, most of it unrealized gains. If fully taxed at the 20% capital gains rate, it could generate $900 billion in revenue. But because these gains are never realized, the government collects almost nothing. ProPublica's 2014 to 2018 analysis of the 25 richest Americans revealed that their combined wealth increased by $41 billion, yet they paid only $13.6 billion in federal income taxes, an effective rate of just 3.4%, far lower than the average American household. The system is regressive by design. Middle-class Americans cannot borrow against their assets tax-free. Home equity loans have high interest, 401k withdrawals incur penalties and taxes, and everyday Americans cannot replicate these strategies. Meanwhile, billionaires borrow at 2% interest, live off loans, and let assets grow tax-free. Larry Ellison, Oracle founder, between 2014 and 2018, saw his wealth grow by $13.2 billion. He paid $1.4 billion in federal income taxes, an effective rate of 10.6%, roughly equivalent to a $70,000 household. Ellison never sells his 1.1 billion Oracle shares, but borrows against them, living off these loans to fund luxuries like yachts and private islands, all legally, with zero tax on gains. Warren Buffett's wealth in Berkshire Hathaway grew $24.3 billion between 2014 and 2018. He paid only $23.7 million in taxes, 0.1% effective rate. Buffett uses borrowings against stock for liquidity, while the majority of his wealth remains untaxed until his death, when the step-up in basis protects his heirs. Elon Musk paid zero federal taxes in 2018. He uses stock options and borrowing strategies to live, build companies, and fund ventures without paying income taxes until forced by expiring stock options. Michael Bloomberg, worth $96 billion, saw his wealth grow $22.5 billion between 2014 to 2018 and paid $292 million in taxes, 1.3%. Minimal salary, borrows against private company stake. The pattern is clear. Buy assets, hold forever, borrow to live, pay minimal taxes, die, and pass wealth tax-free to heirs. This strategy only works for ultra-high net worth individuals. Banks require massive collateral to offer low-interest loans. Step-up in basis matters only for massive unrealized gains. The average person cannot replicate it. This system ensures the middle class pays proportionally more in taxes. Payroll taxes, which fund Social Security and Medicare, are capped at $160,200 in income as of 2023. Capital gains are not subject to these taxes. Sales, property, and state taxes disproportionately affect middle-class Americans. The result is a massive upward transfer of wealth while deficits grow, infrastructure crumbles, and social programs go underfunded. The federal deficit in 2024 is $1.7 trillion. Eliminating step-up in basis and taxing unrealized gains could generate $130 to $180 billion annually. That's enough to fund universal pre-K, infrastructure, debt reduction, and more. Instead, the system perpetuates inequality. Billionaires use irrevocable trusts, foundations, and valuation discounts to minimize estate taxes further. Death transfers $500 billion annually in the U.S., half from estates over $10 million. Step-up in basis wipes out most unrealized gains, ensuring wealth passes largely untaxed. Buy, borrow, die is not a loophole. It's a feature of the tax code, designed, defended, and funded by the ultra-rich and powerful lobbying groups. Every billionaire uses it in some form. Every major bank facilitates it. The IRS can't stop it because it's legal. This isn't about punishing success. It's about fairness. Someone earning $50,000 shouldn't pay 12%, while a billionaire pays 1%. The system is inverted, protecting dynastic wealth at the expense of the middle class, ensuring deficits grow and infrastructure declines. Understanding buy, borrow, die reveals the true mechanics of wealth preservation, inequality, and tax avoidance in America. Politicians talk about raising taxes, but mostly on middle-class citizens, because billionaires are untouchable. This strategy ensures that the ultra-rich continue living like kings while paying almost nothing, passing vast fortunes to heirs completely tax-free.